This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Businessweek Daily with Carol Massar and Tim Stenovec, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
And a very good afternoon, everybody. Yes, indeed, we are across Bloomberg platforms. This is Bloomberg Businessweek Daily. Carol Massar along with Tim Stenovec. And, you know, initially it felt like stocks were running out of steam, but here we are, bouncing off our lows, Tim, and near our highs.
Yeah, still a red on the NASDAQ Composite as we're seeing some selling in tech, a little rotation out of some tech names, but it's barely down. The S&P 500 up 0.3%, the Dow up more than 1 percentage point. Alexis Christoforous is going to be with us in just a moment. She's going to have all of the details.
Reminder, too, the bond market is closed because of Veterans Day. Hey, this hour, what really matters to investors? So we're going to get into the U.S. economy and upcoming Fed policy. We do have one more meeting of the year in December. This is happening as U.S. Treasury Secretary Scott Bessent appearing earlier and making some comments and kind of deflecting on inflation. So we're going to get into all of that with Renaissance Macro's Neil Dutta. Looking forward to a conversation with him.
Plus, on the tech side and the AI trade, from CoreWeave and Meta to Intel and SoftBank, the onslaught of tech news, all with an AI angle.
So much going on. And we're going to get to the top gainer in the S&P 500. Paramount Skydance on post-merger savings, what may be next in terms of a merger or acquisition, what we all as investors need to know about this company. It's coming your way in the next 60 minutes. First up, though, let's get an update on that. I don't even know if we can call it rally, Alexis, but we definitely are off our worst levels of the session. Alexis Christoforous, take it away.
Thanks so much, Carol. I think we can definitely call the Dow a rally, up now 488 points as investors rotate some money out of those high-valued tech names and into other parts of the market with, well, more attractive valuations like healthcare stocks. How about that? The S&P 500 up 15 points. We've got the NASDAQ Composite, though, down by 42, but well off its worst levels of the session. And as Carol mentioned, the bond market is closed for Veterans Day. NVIDIA leading AI-related stocks lower after Japan's SoftBank said that it sold its entire stake in NVIDIA for $5.8 billion. SoftBank's quarterly net profit more than doubled, though, because of gains from its investment in the ChatGPT creator OpenAI. Shares of NVIDIA down 2.5%, SoftBank up more than 2.5%. Company executives are sounding remarkably upbeat about the economy this earnings season, even as trade tensions linger and stock valuations look stretched. Mentions of the words economic slowdown and synonyms during earnings calls tracked by Bloomberg are the lowest since 2007. And Walgreens will no longer give many of its retail workers paid vacation time for Thanksgiving, Christmas, and other major holidays. That's as the pharmacy chain looks to cut costs under new ownership. Now, full-time hourly employees of Walgreens have to work on the holidays to get paid. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Alexis Christoforous. That's a Bloomberg Business Flash. Back over to Carol and Tim.
That seems kind of lousy. Can I just say that?
It's the...
Oh, I guess I cannot. Some might say it's lousy.
I think... You know, I think back on that news from Alexis, I think back to the way post-COVID, during COVID, employees were in the driver's seat when it came to so much.
And remember, we thought it was going to stay that way.
We did.
So work at home.
No, we didn't. We didn't think. We thought, you know, this stuff goes in cycles, but, you know, now we know who's in the driver's seat.
But CEOs were talking a lot more about flexibility.
They were.
Coming right off the pandemic, but things have... Listen, when you build beautiful offices, just as somebody like JP Morgan, you want people to be in the buildings, right?
I like when you ask if you can do things.
I know.
And then they say no. So you take it back.
My whole control room's like, no! All right, let's get to it, folks. A lot coming your way. The U.S. Treasury, we want to remind everybody, kicking off a messaging campaign to showcase the economic benefits of the president's signature legislation. Secretary Scott Bessent announced that last week. And so on that, we heard from him earlier today. The Treasury Secretary deflected concerns about high costs under President Trump, saying the administration had inherited elevated price levels and that its policies would generate real income gains for American workers. He spoke earlier today on Morning Joe on MSNBC.
We inherited an affordability crisis. We have slowed the price increases down, and they are going to continue to slow down, and that real working class wages will go up, and that will address the affordability issue. And, I think this is what Democrats are afraid to do. They've gone to the courts to try to stop President Trump and this great economy. That hasn't worked. They get overruled at SCOTUS. We go to the media, who carries their water. That hasn't worked, so they shut down the government and hurt the economy. Let's keep the economy open, let our policies kick in, and let's see if what I just talked about, let's see if those two lines cross. Costs come down, real wages go up.
And I will say, not necessarily carrying water. We're just reporting out on what we can and what we are seeing. That, of course, was U.S. Treasury Secretary Scott Bessent this morning on Morning Joe on MSNBC. Hey, let's get more on what the Treasury Secretary had to say. Bloomberg News U.S. Treasury reporter Dan Flatley covers him. He is with us from the Bloomberg News Washington, D.C. bureau. Dan, good to have you here with Tim and me. The first line in your story, U.S. Treasury Secretary Scott Bessent deflected concerns about high costs under President Trump, saying the administration had inherited elevated price levels and that its policies would generate real income gains for American workers. We mentioned that earlier as well. Tell us more about what he did say in addressing inflation and how his messaging may be evolving, changing, or being managed.
Yeah, thanks, Carol. It's a great question. So, there's a few different things going on here, right? We had elections last week in New Jersey, in Virginia, in New York City, obviously, and the Democrats did very well in those elections. And I think that has the White House a little bit nervous about what's going to happen with the midterm elections next year. And so what you see now is Secretary Bessent talking about his phrase is extract and educate. So he wants to take some of the provisions from the One Big Beautiful Bill, if you can remember that back to midsummer, and sort of highlight those for people who may not be getting the message. And what this ultimately comes down to is, whose economy is this? If you listen to Bessent, he's sort of still saying, in a way, this is Joe Biden's economy because we've inherited this affordability crisis. Are the voters looking at it as Joe Biden's economy, or are they looking at it as Donald Trump's economy right now? I think we're sort of a little bit betwixt and between, but from some of the data and responses that we're seeing, I think that voters are starting to think of this as Trump's economy, and that may not necessarily be the best thing at this point for the White House because, again, going back to what Bessent said, there's still a lot of things that they want to do that they feel like they can't do, or that they may be losing some support for. So they're really trying to message a little bit more on all of that.
Yeah, I guess the question is, will it work politically? I mean, the data really back up what you're saying, Dan. I mean, if we think about the conversation we had yesterday with Mark Niquette, right at this time on our program, he cited Harris poll data that said half of respondents in an October survey by the Harris poll for Bloomberg News said the economy wasn't working for them, up from 41% in February, and only 1/3 said their finances were better than a year ago. Does messaging actually work with this stuff, or, it's numbers based? Like, people go to the grocery store, they pay their rent, they know what they're paying for things. Does messaging even matter?
Yeah, it's a good question, Tim, and it's fair to say that voters know what they're spending at the grocery store. They know what they're spending on travel. They know what they're spending on their mortgages and on rent. So it is hard to move the needle in terms of what's going out from your pocketbook every month. I do think that messaging can help at the margins. There is, of course, the substance, and then you sort of have the style and the messaging layered on top of that. That can make a little bit of a difference. I do think that looking at the One Big Beautiful Bill, or looking retrospectively at the tax bill, is sort of fraught with peril, because the tax bill wasn't particularly popular even when it passed. And now you're asking people to think back to where they were several months ago, when we all, I think, as human nature, want to look forward and think about what's next. And I do think that in the electorate generally, there is a dissatisfaction with the status quo, and we've seen that in successive cycles where power changes back and forth. So I think that the Trump administration does have kind of an uphill battle in front of them in terms of messaging. We'll see whether what Secretary Bessent mentioned, which is bringing real wages up and bringing the cost of living down, if those lines intersect, they may have the numbers on their side, but we haven't quite gotten there yet.
Just 20, 25, 30 seconds here. Dan, what are you going to be watching as he, though, works on getting the president's and administration's economic message out? Is it going to be more of the same of what we kind of got this morning? I'm just curious.
Yeah, it's interesting. I mean, I do think, he has sort of said, Secretary Bessent has said that he's going to do something basically every other week. But I think even the secretary would say that President Trump is the most effective messenger on his own policies. So I think that, it's going to be interesting to see how those two sort of, vie for attention and space in that lane. I do think that, Trump will have to talk a little bit more about this if he wants to get his message across.
All right, great stuff, as always. Hey, Dan, thank you so much. Bloomberg News U.S. Treasury reporter Dan Flatley. Now, as the U.S. Treasury Secretary looks to highlight the administration policy, whether it's inflation or other aspects of their policies, we continue to live in a world that really lacks U.S. government data. We did get one piece of private data today. ADP research suggested that the labor market slowed in the second half of last month. Traders now, we know, have relied on private data as the government closure, Tim, has delayed the release of official statistics.
Meantime, the government now, and it's well known to the Bloomberg audience, who is with us right now, Neil Dutta, partner and head of economics at Renaissance Macro Research. He joins us from New Jersey. Neil, good to have you back on the program. I want to start exactly there, and with regard to the shutdown, where we are, longest shutdown on record, but also the lack of data. The picture that we're kind of piecing together from various disparate parts show that a labor market is weakening. In your view, how weak is it?
I tend to concern myself more with the direction as opposed to the magnitude, to be honest.
Okay.
But I think we're probably at the Fed's estimate for the unemployment rate for year end already. So a couple of months ahead of schedule. So that's not necessarily a good thing. So my sense is that the speed of the weakness has, maybe picked up a little bit. But I think we're probably at 4.5% already on the unemployment rate.
Okay.
If it were to come out. And, I think, what people need to kind of answer is, why do you think that stops and what gets it to stop? Because I think when you look at it bottoms up, like if you kind of go industry by industry, it's really hard to see where the growth in employment is coming from at the moment.
Well, and on that, I'm thinking about, Neil, great to be talking with you again, the dual mandate, right? And so I'm just wondering if we continue to see weakness, in the labor market. And then we just talked about Treasury Secretary Scott Bessent kind of deflecting when it came to inflation, as he's out and about talking about the administration's policies. I mean, we've heard from Fed Chair Jay Powell about the struggles on both of those mandates. Do you think it's going to be a bit of a squeeze for the Fed, for the U.S. economy, for all of us, in terms of weaker labor market staying that way and inflationary pressures kind of staying that way?
Well, my own view of it is that I don't view the trade-offs as nearly as onerous as the Fed does. I think there's more downside risk to the labor market than there is upside risk to inflation. At the end of the day, inflation is 3% this year. It was 3% last year. The difference between this year and last year is tariffs. So that would tell me what? That underlying inflation is probably slowing. And, the fact that it's really hard to make a case for why tariffs are anything more than a one-off lends support to the idea that the Fed should continue to cut interest rates here. In terms of, and remember, to me, the big story is that employment tends to evolve potentially in nonlinear ways. It kind of, once like a increase in the unemployment rate really gets going, it tends to keep on going. And that's why you have this sort of, it's episodic, right? You see big spikes in the unemployment rate at times, right?
Yeah.
That's not really the case with inflation. And so in other words, inflation tends to move in a more linear way and, particularly outside of commodities. And unemployment, that's not necessarily the case. It tends to be more nonlinear in fashion. And I think that's what, frankly, the Fed and, the markets might be missing is the sort of downside kind of growth tail risks associated with the labor markets.
What if the Supreme Court comes back and says the tariffs are not legal as they're implemented? Does that change your view?
No, I mean, I think if you think that the Supreme Court is going to be the institution in Washington, D.C. with the last word on tariffs, I think I mean, I'd like to have some of what you're smoking.
Well, is that because you think there are other avenues for the Trump administration to enact these
the
tariffs
fact
apart
is
from
that
IEEPA?
Absolutely. The Congress, I mean, this is really about Congress, and Congress is frankly a lazy bunch. Okay. And they've delegated a lot of their tariff authority to the White House. And there's a vast legal architecture from which the president can draw from to prosecute a trade war. And, you know, I think immediately he could probably do a temporary 15% baseline tariff, and he can do that for 6 months. And that will, you know, sort of act as a bridge, you know, to get towards national security tariffs. So I don't think we're out of the woods on tariffs because the SCOTUS rules it one way or the other. I mean, I think that's sort of wishful thinking, in my opinion.
Hey, a couple of stories I just want to bring in. One was from last week, Neil, and it was about U.S. consumer sentiment tumbling to near the lowest on record. And part of it was the government shutdown weighing on the economic outlook, but also high prices, souring views about personal finances. There were also concerns about the labor market continuing to weaken in the future. We got that from that report. And then we just had a story that our Alexis Christoforous mentioned about Walgreens no longer giving many of its retail workers paid vacation time for Thanksgiving, Christmas, and other major holidays. The company looking to cut costs under new owners. Like, I just keep thinking about this K-shaped economy, and there's just so many people, and I think about the SNAP benefits. How many people are on food stamps and getting assistance? Like, this economy doesn't feel great, and yet we have records on Wall Street, and we have earnings that seem to be okay, and the AI spend is out there still in a big way, even if there's been some questions over the last week or so. So I don't know, from an economic perspective, are we in a good economy or no?
I mean, I think we're in a deeply imbalanced economy, Carol.
Okay.
I mean, and it's been that way for a while.
Yeah.
You know, I recently wrote a piece for your colleague Joe Weisenthal on Odd Lots. You know, just sort of characterizing the economy as really three different things, right? You have the housing market, which I think is in recession, and you have the consumer, which is kind of, let's say, in the middle. And then you have AI, which is, you know, booming. And when I go to client meetings and I give my sort of outlook on the economy, you know, the pushback that I get is kind of what you were describing, right? It's, you know, AI, it's stocks, it's, you know, the high-end consumer. And people talk about that, frankly, as if those are three separate things, but they're really derivatives of the same thing. And I think that's something to keep in mind here. The other thing I would say is that, you know, we talk a lot about the resilient consumer. We hear a lot about, you know, never bet against the U.S. consumer. The truth is the consumer never actually gives you a signal ahead of an economic slump, right? If you go back historically, consumer spending has never, ever declined in the quarters leading up to a broader economic downturn.
Interesting.
Sometimes in an economic downturn, consumer spending actually expands. Right? Like, go back to 2001, right? Like, so that's not unusual either. So if you're waiting on the consumer to give you a tell, you've probably waited too long, right? I mean, consumption has a way of amplifying downturns. But I would just say, you know, what's been interesting to me is just how, like, the labor markets have evolved the way you've expected, right? It's come for the young people first, and I think it's going to come for the affluent next.
Interesting stuff. Ouch. Yeah, well, this is something we talked about, the 3 A's in that Trump economy story. Neil Dutta, good to connect again. Come back soon. Partner and head of economics at Renaissance Macro Research. Hey, coming up, our tech roundup from SoftBank, Meta, Intel. It's all about AI.
2:21 on Wall Street. I'm Alexis Christoforous. We've got a tale of two markets today. The Dow is up more than 1%, but the Nasdaq a bit lower as investors move some money out of those high-valued tech names. The Dow Jones Industrial Average up better than 1%, or 510 points. The S&P 500 gaining about 16, but the Nasdaq Composite down 44 points. For the Dow, we have got Merck, Nike, and Amgen leading things higher. Just 4 of the 30 Dow stocks are lower right right now, led there by NVIDIA. Shares of Paramount Skydance up about 9% after the company raised its target for job cuts and cost-saving measures. Paramount plans to lay off another 1,600 workers and aims to save at least $3 billion in costs. The entertainment company said it will also hike prices for its Paramount Plus streaming service early next year. Shares of Occidental Petroleum up about 1%. The oil and gas producer posting mixed quarterly results. Earnings topped expectations, but revenue disappointed. And tariffs are forcing some big brands to cut back on their Black Friday deals. Companies from upscale handbag brand Coach to the wellness device maker Therabody, among those pulling back on promotions. They're citing higher costs due to tariffs and inflation. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Alexis Christoforous. That's your Bloomberg Business Flash.
All right, got it. Alexis, thanks so much. Hey, time for our tech roundup. Everything from CoreWeave results, AI execs moving around, and SoftBank exiting its entire stake in NVIDIA. All right, first up, let's talk CoreWeave. Shares of the company tumbling after it lowered its annual revenue forecast due to a delay in fulfilling a customer contract. It's a setback for a company that's racing to keep up with the AI boom. Earlier today, CoreWeave's CEO Michael Intrator joined the BTech team on Bloomberg Television, Caroline Hyde and Ed Ludlow, and the CEO talked about broadening their customer base and suppliers.
If you think about the messages that I was trying to communicate during the earnings call yesterday, I talked about the incredible impact of the effort that we've had to diversify our clients. We started the year with 85% of our revenue to a single client, and we are coming out of the year with our backlog with which has reached all-time highs, where no specific client is more than 35% of it, and that is down from 50% even last quarter. You're seeing a real focus by our company to diversify on both sides of the the ledger. The clients that we are delivering infrastructure to, as well as the suppliers that are delivering us the components that we need to be successful.
That's CoreWeave CEO Michael Intrator with BTech host Caroline Hyde and Ed Ludlow on BTV earlier today. Hey, joining us to talk about CoreWeave and some other things that are going on in the tech space, all with some AI aspects. With us is BTech co-host Caroline Hyde, along with Bloomberg Intelligence Global Head of Technology Research Mandeep Singh, both here in studio. I want to get to the interview in a moment, but I want to bring in you, Mandeep. Step back. What insight did we get on the company's business as a result of this quarterly update?
That data center demand far outstrips supply, and it's not just at the chip level. It's actually at the facility level, because in this case, they were not able to bring a data center online in time to fulfill, a customer order in terms of giving them the GPUs. And so this is way beyond chips at this point of time. I mean, he didn't attribute it to power specifically, but it's more at the facility level than it was at the chip level before.
Caroline, come on in here, because you guys asked the company's CEO, Michael Intrator, who we just heard from, specifically about the delay and the client. And, this company has been not under pressure, but critics have essentially said, and he addressed this, that, there's a small number of clients that pay a lot. Do we know anything about the client or the partner that ordered this, or where the bottleneck is coming from?
He's very loyal, so he wouldn't name the client.
Okay.
He wouldn't name the data center builder partner that has got them into this mess. But you're right, ever since CoreWeave went public, it's one of the first neoclouds to be in public shareholders' hands. What's a neocloud? It's this new form of accessing compute. And people are still trying to struggle as to what really the underlying assets is that they own, how the business model really works, and what is clear from this hiccup in its supply chain is that it is dependent on an entire ecosystem of which it can't control. He was very clear about that in the interview, saying, look, usually they have very good partners. They still think that this partner is a good one. They work with them significantly. But there are going to be choke points. There are going to be bottlenecks, whether it's power, whether it's access to just permissions to build, whether it's going to be the cooling systems that they have around, whether it's access to the servers, GPUs. In this case, it was sort of the PowerShell situation. It's more the interior of the data center. But I think what he's trying to make clear here is that his business will eventually thrive as it scales out, as it's less dependent on one single data center builder, and as they build out more of their own. He's building out his engineering talent, his labor force, so that he can, in a vertically integrated manner, bring on NVIDIA's relationship that she thinks is really core to the business offering, get the GPUs in place.
Well, the assumption is, right, Mandeep, is that this, we're seeing incredible demand, and whether the power is not there or there's, hiccups in the supply chain and kind of meeting all of that demand, the assumption is that demand, though, is going to stay and continue to grow. But is that still possibly a question in terms of the need, the use of AI, the implementation of AI, and all that it brings with it? Is that demand, can we assume it's going to stay or really just grow at the current levels? Like, do we know that for certain?
I mean, we track the backlog numbers of all the hyperscalers, and CoreWeave actually give out a backlog number which grew 85% quarter over quarter. So, when you look at the aggregate backlog number, we're talking about 1.2 trillion in aggregate backlog for all the hyperscalers, including CoreWeave. And that has grown almost 500 billion this year. So when you see that kind of growth, I mean, companies are committing, whether it's a 5-year contract or a 3-year contract, that backlog is a committed contract. And in the case of CoreWeave, that 55 billion will translate into revenue over the next 5 years. And I'm not even including the OpenAI deal, which I don't think is part of that backlog. So these are committed contracts. And so CoreWeave is at a revenue of $6 billion run rate. You can see from the backlog, even with a 5-year duration, they'll have 11 billion of revenue next year. So you add up 11 billion in revenue for next year. So from that perspective, I mean, the visibility and the line of sight is pretty clear in terms of that translating into revenue. Margins is where the big question is for a company like CoreWeave, because these assets are not 15 to 20-year-old useful life assets. These are probably 3 to 4 year useful life.
So the rebuild will have to happen.
And then you have to get new NVIDIA GPUs and, the use. I mean, that's the other thing that could have delayed this, because everyone is waiting for the latest Blackwell chips. Nobody wants Hopper. So if you're a CoreWeave building a data center, your customer is asking you a data center with the latest Blackwell chips as opposed to, Hopper. And it just that there wasn't enough time to build a completely new data center with Blackwell chips, so that's why they delayed it by a quarter. Again, it's a hypothesis. We don't know for sure. Right. But that could be one of the reasons as well.
But Caroline, to your point, you went through a whole host of issues that could cause a delay in something such as this, including power actually getting hooked up to something. John Gittleson out with a story yesterday about 2 data centers in Santa Clara that have been built and that are just sitting there because there's no power connected to them. It hasn't been hooked up at this point. Is there an opportunity for at least local, state, or the federal government to actually come in from a permitting perspective, from some sort of removal of red tape to actually make this process easier and to remove some of these choke points?
I love that you asked that question, because that's exactly what we asked Michael in Trader. And he was like, I would like significant government support here in terms of permitting, in terms of streamlining, in terms of ensuring that we can get these enormous investments online as quickly as possible. So yes, the government can and should play a role from his perspective. He's not in any way starting to encroach on the whole Sarah Fryer backlash that we got last week with OpenAI, and a worry about, whether or not the government should in some way be talking about the GPU asset deterioration. And that's exactly where Mandeep was just taking us, because these are depreciating assets. And we don't actually know how quickly they depreciate. Chris Bryant out from Bloomberg Opinion writing a beautiful piece today all about saying, and leaning into Michael Barry's piece here, that a lot of these hyperscalers are perhaps being too optimistic as to how long this infrastructure, the GPUs, will actually last. Are A100s still useful? Many would say they're still using them at 100%. But are they really? Are we really going to see 4-year, or is it 6-year? We don't really understand. And that's a key question that sort of hangs over everyone's head. But maybe that was where, at the time, the trial balloon went up from OpenAI. Does the government want to back that? No, it doesn't want to back that. Okay, we never said that to begin with. Maybe only if we're going to be chip manufacturing. But I think more broadly, that's a different set of questions than really what the supply chain chokehold is that we're currently facing in the US, and whether it slows down. Look what's happening in Europe today. Microsoft scaling out in Portugal in a big way, using Nscale, a competitor. We're seeing Nebius rising 300% in terms of revenue. There's a lot of neoclouds people could depend upon, but from Michael and Trader's perspective, none of them can satiate demand. None of them will put together.
I guess what I keep thinking about, and I know it's not apples to apples, but like the great financial crisis where it was like so much money out there, the build on houses, and then we had all these empty houses and developments. Could we see, Mandeep, like this build out of data centers, and then ultimately, okay, the demand longer term isn't there, and that we have all these empty data centers?
I mean, so far we are not seeing any signs where people have said, we don't want to use more AI compute or anything along those lines. If anything, hyperscalers themselves are the biggest users of compute. Yeah. When you think of Microsoft, Google, Meta, I mean, yes, their cloud businesses are growing, but they are among the biggest consumers of the AI compute. Right. So from that perspective, I don't doubt, that there will be a demand issue, at least in the near term, because they are the ones who have more demand for their own chips.
So, all right, we only have a couple minutes. There's so much going on. We've got AI execs moving around, Meta's chief artificial intelligence leaving to launch his own startup. That's from the FT. Intel's chief technology and AI officer leaving the company to take a role at OpenAI. You've got SoftBank selling its entire stake in NVIDIA. Got about 45 seconds each. You take one story that you think is interesting.
I think the NVIDIA SoftBank one is interesting because I don't think this is the AI bubble popping either. And I think that's what that headline stirred, anxiety. Oh my goodness, they're getting rid of all of their NVIDIA stake. Why? Because it's risen as much as possible.
$5.8 billion.
Which isn't much. It's a $5 trillion company. Should have weighed on the stock that much. Maybe there was a little bit of just reaction to the headline. But ultimately, this is a clever bet by SoftBank. They bought back in 2020. $3 billion became $5.8 billion. They're going to redeploy that money into OpenAI, which is only going to build and buy more NVIDIA GPUs in the longer term. I kind of think it's a good story.
Circular finance
Get out the whiteboard.
It still survives.
But maybe the concern, Mandeep, is that, SoftBank sees the opportunity being greater in these startups than it does in NVIDIA. That's why they're getting out of this investment and putting it somewhere else.
I mean, if anything, our thesis is the concentration is becoming even more kind of peculiar in terms of how these companies are the ones who are dictating whether it's the LLM players or the cloud guys. Because with AI, I mean, even like with cloud, you have 3 hyperscalers. With AI, I think the concentration is becoming even more powerful, and that's the one thing.
Powerful, good. Powerful, scary.
Scary, actually, and that's where you see these departures. Why are these guys leaving for OpenAI? Because that's where everything is happening. And
it's the nucleus. I feel like. Oh my God, that was so much fun. Come back tomorrow and do the same thing.
Oh, please, always.
VTech co-host Caroline Hyde, along with Bloomberg Intelligence Global Head of Technology Research Mandeep Singh. Still to come, the #1 gainer in the S&P 500, a name that is in the media a lot. That when we continue.
2:40 on Wall Street. I'm Alexis Christoforous, and it continues to be a split market. The Dow Jones Industrial Average rallying 549 points to 47,920, led higher by Nike and healthcare stocks. In the broader market, the S&P 500 up 18 points, but the Nasdaq Composite in the red by about 39 as investors shy away from some of those high-value tech names. Speaking of which, we've got shares of AMD slightly lower today. Its CEO, Lisa Su, says annual revenue growth will average more than 35% over the next 3 to 5 years, and that AMD's AI data center revenue will increase by an average of 80%. Su predicts the total AI chip market will reach $1 trillion by 2030. Elsewhere in stock news, shares of Beyond Meat trading down about 7% after the plant-based meat company reported third-quarter results that missed analysts' expectations. It also provided a weak forecast in the fourth quarter. And shares of Gemini space station sinking 15%. This is the crypto exchange founded by the Winklevoss twins. It's reporting a steeper loss than expected in its first earnings release since going public. And shares of Sony rallying today, the company raising its profit outlook and getting a boost from recent hit titles, including the anime movie Demon Slayer. Shares of Sony now up nearly 4.5%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Alexis Christoforous. That's your Bloomberg Business Flash. Back over to Carol and Tim.
All right, Alexis, thank you so much. Hey, one stock and company that we wanted to highlight, it is the number one gainer in the S&P 500 today. It's up about 9%. We're talking about Paramount Skydance, shares rallying. In fact, they've been up more than 12% at their intraday high today after the newly merged company raised its target for job cuts and cost-saving measures. As you know, the media and entertainment company has also been trying to buy rival Warner Brothers Discovery. It also said in a letter to shareholders, we talked about this a little bit, that it plans an additional 1,600-person workforce reduction and did lay out a specific goal to achieve at least $3 billion, Tim, in cost savings.
With more on the results, the company and its place in the world of media and its future, too. Bloomberg Intelligence Senior Media Analyst Geetha Ranganathan joins us. She's at Bloomberg Intelligence headquarters in Princeton, New Jersey. Geetha, is today's move, before we get to the big picture, is today's move all the result of that at least $3 billion in cost savings? Is that why investors are happy today?
Yeah, absolutely, Tim. So, the $3 billion cost savings target, which was upward guidance, revision from the $2 billion, basically caused them to lift their EBITDA target for 2026. I mean, when I say lift, it's much higher than what consensus was expecting. So consensus was expecting around $3.1 billion for 2026. They came in at $3.5 billion. So I think that really gave investors some cause to cheer, and that's driving the stock upwards today.
Well, we should just remind everyone. Carol always points this out, that that includes an additional 1,600-person workforce reduction. So I would imagine there are people within the organization that are worried about not having a job in the near future. Do we know at all where these layoffs will hit?
So these layoffs, actually, the 1,600 are going to be a part of their Latin American operation. So they're going to do some of the divestitures of their LATAM assets in Chile, in Argentina, and a lot of those job cuts are actually associated with that.
All right. So, you know what, Geetha, I keep thinking, is this the media company to watch right now?
It definitely is, Carol. So, a lot of what David Ellison and his team laid out yesterday, I mean, they came across as a really strong team with a very, they have a game plan. They know what they're doing. But at the end of the day, and if you just look at the playbook, right, you guys mentioned the cost synergies, which are a big part of, the forward plan. But if you just kind of think back a few years, this is so reminiscent of exactly what Warner Brothers Discovery did. This was their playbook. They came in with, the merger of Warner Brothers and Discovery. They kind of kept raising their synergy targets. But at the end, what happened was everything fell apart because they couldn't really kind of get to the initial EBITDA target that they had laid out up until this year, of course, when they, kind of came out with their whole plan to separate the company. So one doesn't really know what's going to happen with Paramount Skydance. So yes, things looked pretty promising as laid out by the management team yesterday. They obviously are not afraid to make big, bold bets when it comes to content. We saw them. They're ready to spend about $8 billion on UFC content. They obviously are more than willing to go after Warner Brothers Discovery. But at the end of the day, it's going to come down to, execution. Are they going to actually be able to execute? And even if they do execute, is it going to be enough? Those are really the questions, because I'm not sure. Yes, they might be able to drive up their streaming subscriber base a little bit. They have about 80 million right now. But then when you're competing with Netflix, which has well over 310 million, again, what do? You need something transformative. So you do need that Warner Brothers Discovery acquisition.
Well, I do think about kind of where media companies are going, Geetha. Who would have thought at one point that the major networks would ever be challenged? Who would ever thought, ESPN went through its own, we've seen things that were juggernauts or a given that it's just not the way it is anymore. So many of us are watching YouTube television, or we're watching things on our phone, or, we don't care what time things are on anymore. It's just been turned upside down. Look at the news business, how much that has changed. And I do think about, what is the media company of the future?
The media company of the future is one that can be agile, that can be nimble, and that's exactly what Netflix has been able to do in terms of, making. They did make the content investments when they needed to make it, but then they were able to pare back when they realized that, that couldn't go on forever, and when they were burning through free cash, right? the content company, or rather the media company of the future, is one that can, adapt. We have to make investments in AI. We're seeing that AI is going to really kind of change the game when it comes to recommendations, when it comes to kind of tweaking algorithms, and even when it comes to cutting down on content costs. We're already seeing this play across the board. In terms of post-production cost, it can kind of lead to a significant reduction. We're thinking at least baseline 10%. And so a company that's able to achieve that and is ready for that is going to, really position itself for the future pretty well.
Back to the idea of what assets the company might need to add in the near future. David Ellison on the call, Geetha, said he couldn't comment on speculation around deal making, but said there are no must-haves for us. Do you agree with that?
Is he just not trying to show his hand?
Like, are there some assets that are must-have for this company?
I think so, Tim. I mean, again, they did, full credit to the management team. They do seem to have a good strategy. They seem to be very bold and ambitious. There's absolutely no doubt about it. They are not going to just be okay with the status quo. That is absolutely clear. But, in their current configuration, I just don't think it's going to cut it when they have to compete with the likes of a Netflix or an Amazon or a Disney. They do need a better studio. Yes, they're committing to basically doubling their theatrical output. But if you just kind of look at the performance of the studio over the past so many years, it has clearly been such a laggard. So, getting some of those Warner Brother titles, I think, is transformative. They do need something for their streaming assets as well. Again, they're doing a lot of things that they can again in the current format, but again they need a lot more content. The UFC is good, the NFL they have, but I don't think that's good for some amount of customer acquisition. I just don't think it's enough.
Hey, swallowing Warner Brothers, if indeed Warner Brothers Discovery, if indeed that gets done, I mean, I think we all keep being like, well, wait a minute. Paramount Skydance is about an $18.3 billion market cap. Warner Brothers is about almost $57 billion. I mean, it's going to be a lot of debt, right? We see that typically in media companies. Is it manageable?
I think it is manageable. I mean, we have to remember here that, this is a little bit of an unusual situation. This is David Ellison. His father is one of the richest people in the world. So I think financing might not necessarily, I mean, yes, we've heard all these different reports of, the Paramount team kind of looking for private equity partners. We really don't know exactly how the financing structure is going to be. But I think, in the grand scheme of things, and we've seen this even with the Warner Brothers Discovery, management team, that yes, they do have to take on a lot of debt, but I think in the end it will be manageable because they still will have a good amount of free cash flow.
All right, we're going to leave it on that note. Hey, Geetha, thank you so much. Geetha Ranganathan, she's senior media analyst at Bloomberg Intelligence, joining us from BI headquarters out there in Princeton, New Jersey. As we mentioned, Paramount Skydance continuing to be the top gainer in the S&P 500. Tim, that stock up about 8.7%.
At one point, it was up 12.5%, so off its best levels of the day, but still enough to the upside to be that best performer in the S&P.
I love it, though. It's just kind of interesting. We'll see where it goes next. All right,
Are you
folks,
watching anything on Paramount Plus? Because those price increases are going to come.
I don't know. It's all a mush to me. I just go to the menu, I click.
It's not what they. That's not what they want to hear, but that is the reality for so many people.
Stocks on the move when we come back.
You're listening to Bloomberg Businessweek Daily with Carol Massar and Tim Stenovec on Bloomberg Radio and Television.
All right, everybody, coming up on the last hour of trading, Carol Massar, Tim Stenovec, live at Bloomberg headquarters in New York City, and we have stocks pretty much hovering near their best levels of the session. So the S&P 500, yep, we are up just slightly, up about 20 points, call it good for a gain of 0.3%. Dow definitely an outperformer, 1.2% to the upside, Tim, but the NASDAQ under a little bit of pressure, just slightly.
I'm Tim Stenovec along with Carol Massar. Let's take a look at some stocks on the move today. With us is Bloomberg TV markets correspondent Norah Mulinda. Norah, NVIDIA.
Yeah.
When it moves, it has an outsized effect because it is so valuable.
Absolutely. I mean, this is a name that the entire market watches. Of course, we do know that this is a stock that's going to be reporting next week, but we are seeing shares of NVIDIA in focus down about 2.6% as we speak. And of course, we know this is after yesterday. We saw the stock hit its biggest jump since early April. So we are seeing a pairing here of those gains. This is after SoftBank said that it will be selling its entire $5.8 billion stake in the company as it looks to really go all in on the ChatGPT maker OpenAI. So, of course, we are seeing this discussion, an ongoing discussion right now about a potential AI bubble. So of course, this is kind of underscoring a lot of those threats, those concerns, and also just about whether or not, if they're pulling out this funding, what does that mean for NVIDIA more broadly? But
I get it.
Isn't it going to have to buy NVIDIA chips?
Yes. Yeah,
like if it's increasing.
Yeah, OpenAI will have to, but I get it because SoftBank's essentially saying, they're signaling, okay, we think the opportunity is better for us outside of NVIDIA than inside of NVIDIA.
Right. Yeah.
And maybe that's what has the market.
And they probably made a lot on their investment, right?
Mm-hmm. I mean, that's also what is also something being discussed right now, but interesting nonetheless.
Yeah. I think it's interesting.
Yeah.
We actually have talked about this a lot. Good stuff. Real. This one definitely on the move.
Yeah, this one on the move. This
no
is
AI. Well, there probably is AI.
I mean, at this point, isn't every company incorporating it at this point, Carol?
Sounds like it.
Well, we're looking at shares of Real. They are on a tear, up as much as 38% in today's trade. This is the best day this year that we've seen for the stock. It's on track to close at its highest level on record. This is after a boost to its forecast. Of course, we know Real is more of a second-hand consignment luxury good outlet, if you think about it that way. And so you are really just seeing this as we're thinking about the consumer right now, of course, still being strapped. But as you think about where you want to put your cash, for those who are spending money on luxury, apparently they'd like to get it secondhand because you can knock off the price a little bit there. So we are still seeing this stock really seeing some strong gains, up about 38% so far if you look over the past 12 months.
I will say 25% of the float was short. So any kind of good news, and if the stock's moving up to the, moving big time to the upside, right? You see some short covering.
I feel like I should
You'd love to look at the short interest.
I
That's
do.
good to point that one out there.
I just think, we're always like buy, but you got to look at the other side of the
Absolutely.
Should I be selling stuff to Real? Would they even take the stuff that I have?
Depends on what you have, Tim.
Yeah, I don't think they'll take it.
Doesn't hurt to try,
no
right?
Comment. No comment. All right, let's talk about CoreWeave. This is certainly a top story for us on this Tuesday.
Yeah, what is today, right?
I don't know.
Well, CoreWeave, this is ticker CRWV. This is a stock that, of course, IPO'd back in late March, but today not seeing a great day. Shares down as much as 17%. That's the most since August. This is after the company reported third quarter earnings, but they did talk about a data center delay, which they see could potentially be snagging or creating some sort of impact on its fourth quarter earnings. So you did see JP Morgan coming in, downgrading the stock to neutral from overweight. Analysts are still saying that supply constraints are okay over the short term, or there still tends to be some sort of constraints here in terms of supply on the near term. But overall, it seems as though this isn't the worst thing here for the company, but you're definitely seeing their shares taking quite a bit of a beating today.
Yeah. CoreWeave, one of the neo clouds.
Yeah, a lot of our conversation ahead of earnings focused on the three core customers, according to the supply chain function on the Bloomberg terminal: Microsoft, Meta Platforms, and Alphabet. And the company's CEO on Bloomberg TV was quick to point out
that they're
diversifying.
Mm-hmm. Correct. Which is, I think, an important thing, to kind of stress, right? Considering that this has been something that folks have been concerned about. I mean, this stock is up how much from its IPO? Was it back in May?
That was back in the end of March. March 28th is when they IPO'd.
Okay, so I'm just looking
here.
It's
off of all-time highs still.
124%?
124 is what I'm seeing as well.
Yeah, so it's definitely had a run from its IPO. But
so what's today in the grand scheme of things?
It's down 50%, down 50% from its peak back in June.
Yeah, that's a pullback. That's a definite pullback. All right, good stuff. Norah, thank you so much. Bloomberg TV markets correspondent Norah Mulinda. Check out our Stock Movers podcast. They are 5-minute episodes of the biggest winners and losers in the stock market. You can find it anywhere you get your podcasts.
Hey, we got a great program continuing on Bloomberg Businessweek Daily on radio, YouTube, Bloomberg Originals, and more. We've got a trio of C-suite executives.
We do.
Coming from publicly traded companies. The CFO and EVP of Lumen Technologies is going to be joining us. That stock has been on a tear. We've got the CEO of Angie. Post-earnings, that stock took a big hit. And also the CEO of Travel and Leisure Co., another stock that has hit a record of late.
So covering different aspects of our economy, which is kind of cool. We're also going to talk to our own Josh Green. Love it. We've been dying to talk to him about the elections last week and just kind of, the shutdown, the Democrats, a group of them, what some say, caving in and going against their party. And so what does it mean? Was it pathetic or a terrible mistake, as Governor Gavin Newsom and Senator Elizabeth Warren said, respectively, or was it politically savvy?